I think you might have a play here with your pick of the
Yep.
week. And so your pick of the week this week is Citigroup, ticker symbol C.
Yep. Citigroup is a candidate, and this was actually brought up to the attention of my group yesterday. But Citigroup is one that I have been selling premium against for quite some time. This is one of the banks that did not slip through the cracks. They are under heavy scrutiny to meet like quarterly like stress tests. They have to have a certain amount of money so that they can bail themselves out. They did not fit, they did not uh, they fared well through the crisis 15 years ago, but they are under scrutiny. So I don't feel at all worried about Citigroup having any problems. They are doing well with their earnings, as you can see here, and they give a lot of money back in the form of dividends to their investors, which we like as premium sellers because if they're giving money back to investors, number one, we can roll that into our strategy. But number two, that means that the investors, because they're making a nice chunk off of dividends, aren't going to be pushing Citigroup to have their stock price change much. And so we like that sideways choppy movement that I'm showing here with Citigroup. And so if you take a look over here, Citigroup is coming and testing this level of support. So despite Citigroup being a pretty solid bank, they still were under just the public sentiment of being a bank. All the banks like got hit last week when Silicon Valley Bank and Signet Bank and our Signature Bank and Credit Suisse hit some troubles. So they came back down to this level of support, which gives us premium sellers an amazing opportunity, and that is to kind of stock up on either Citigroup, the stock, or if we want to do a leverage play, we could find kind of a deep in the money, far out in time option to replace that stock. So I'm talking about a June, let's go with January 2024. So that's more than 8 months out in time, expiration date. And here's a little trick. We come over here and we look at the option chain, and I'm going to look at those January 2024 options right here, expiring January 19th, 2024. And you'll notice I have a couple of columns here. One of them is the extrinsic value column, and the other one is the mark column. So if you take whatever the extrinsic value is and you divide it by the mark, you'll get a percentage, right? And so I'm going to do that right here. What I'm looking for is less than 5% extrinsic value. So if I bring my calculator over, this will tell you how deep in the money you should go when you're going to replace the stock in the case of our premium selling with an option. So say, for instance, I take a look at this $35 call and my extrinsic value is 279 and my mark is 11,675. So I go $2.79. It just changed, but I'll use sure. 279 divided by $11.67 and a half. And so you'll see that this is 24% extrinsic. Again, we want to target less than 5%. So we have to go deeper in the money. Let's go all the way to, I'm kind of looking at these. Let's go all the way down to the $25 strike price. If we take a look at the $25 strike price, again, extrinsic divided by mark, 83 cents divided by $19.70, 83 cents divided by $19.70. You'll get 4.2%. That's below our 5% threshold. This is a great option. And you can see there's open interest. The bid-ask spread shows that there's actually buyers and sellers there. So you wouldn't have any problem buying and selling this. There's actual volume today. So this $25 call would be a perfect substitute. So instead of spending $43.94 per share, we would spend only $19.72 per share on this alternative. And so stocking up on either the stocking up, that was a play on words, buying either the stock or that back month option that we just devised would be really great here because then we would be totally set up for our premium selling, and we'd be able to do that month in and month out, just like cyclic, turn it into an income trade, be on the correct side of that equation.